Since I began investing several months ago, 2021 has been the strangest year I've ever invested in. Now, I have to admit that I pity novice investors who are just starting into this stock market because it is quite difficult to navigate these murky waters if you don't know what you're doing. But that's why I'm doing this video in the first place. I'd want to offer a framework that will assist you navigate through these, shall we say, intriguing times without being burned out. Now, of course, one video isn't going to turn you into an investment genius, but it will set you on the right track to investing successfully during tumultuous times. I'll be offering 5 tips with you that both Buffett and I employ. They are used by the top investors to outsmart other investors and win in the long run. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my best greetings. And to be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. Let's get to the video as quickly as possible. Those who can handle feelings and emotions will be one of the things that will separate average investors from great investors during these circumstances. Here's an example. Jordan Peterson suggests that at a relative's funeral, we should be the dependable ones. It is critical that we expand on that advice and apply it to investment. Investing during and after a market fall in particular. This is, after all, the attitude that 90% of investors adopt. They are ecstatic when their stocks rise in value. They go to the club to tell their pals how much income they've earned. They check their stocks regularly, if not frequently. And their emotions are all wrapped up in the stock market's highs and lows. The top 1% of investors, on the other hand, are individuals who do the exact opposite of what those people do. The investors who win are actually pleased with their equities fall in value, since it means they may acquire more at a lower cost. They understand that the lower the price at which they purchase equities, the bigger their long-term profits will be. Buffett believes you're dealing with a lot of dumb people in the marketplace. It's like a gigantic casino and everyone else is getting drunk. Because of this exact premise. Buy low and sell high. Unfortunately, the majority of investors do the absolute reverse. If you want an advantage over other investors and get large returns, you should invest in sectors that you are familiar with. So what I suggest is that you take a step back and analyze the areas that you are familiar with, okay? If you're a young fellow, you could be interested in games, artificial intelligence, social networking sites, or a technological company. If you're older, you may have an edge in more established firms. Possibly hospitality, traveling, liquor, and cuisine are some of your passions. Something along those lines, I suppose. Buffett only invests in more established business concepts that he is familiar with. See's Candies, which offers sweets, is an example of a long-standing business strategy that Buffett knows. Insurance, for example, is something Buffett spent a lot of time learning about. He knows the game so well that he can identify strong investment businesses, and you should be doing exactly what Buffett does. As I previously stated, if you're young and enjoy gaming, you'll probably have a better understanding than most of what firms will lead in the future and what sectors will flourish. As a result, one of Peter Lynch's most famous comments is both simple and brilliant. Know what you possess and why you own it. Most investors want to earn money in every area, and they all want to brag about all of their firms to their buddies at the club, but they seldom stick to industries that they are familiar with. They seldom have a clear understanding of what they possess and why they own it, and that is why you should not follow in the footsteps of the majority of investors. Do you want to join me and my pals for a game of poker? I'd ask a random individual who had never played poker before. We'll each contribute $500. If that individual answers yes despite the fact that he has never played poker before, he'd be beaten and lose all his money. He'd be a fool. And if we apply it to the stock market, you'd be surprised at how many novice investors do not understand the fundamentals of investing. And after 2 or 3 years, they are eventually crushed. If you're new to the stock market investment, especially in these uncertain times, here are some fundamentals you should know. Okay, one of the most crucial indicators to understand is the PE ratio. Essentially, it compares how much you paid for a stock to how much it earns. Another consideration is the return on investment, a useful statistic for assessing a company's profit-generating efficiency. Do you have any knowledge with stock market orders? What exactly is a limit order? What about the market order and the limit stop order? Before you invest, you should be aware of the following. You know your present grasp of a variety of fundamental methods that you may employ, such as Warren Buffett's value investing strategy of buying at a discount to intrinsic value. Do you have any familiarity with the dividend aristocrat strategy, a set of equities into which you can dollar cost average and, according to history, outperform the market over time? It is very critical that you understand these key methods. These are some simple strategies that you may employ. But before you become an investor, familiarize yourself with the PE ratios. This is one of the most basic investment guidelines, but it is also one of the most difficult to follow. Most investors are preoccupied with stock market news on daily, weekly, and monthly basis. The point is, every time you get a bit of news, you get a dopamine rush. As a result, 90% of investors are fixated on the stock market's short-term fluctuations. Now, I don't mind this, but it has a detrimental impact on the way you invest, and as a result, your investment results. One of the drawbacks of focusing at the very short term is that you miss long-term trends. If you look at the stock market for a week or even a month, they are usually little dots of a longer-term pattern that is occurring. As a result, if you're committed to the short term as an investor, you'll make judgments based on that, which will result in lower investment results overall. This is why Warren Buffett advises, only buy something you'd be completely pleased to own for the next 10 years. Don't be too concerned with the daily news or the little details. Now, the next topic you should be thinking about is market cycles, particularly in 2022, when we'll be nearing at the end of the cycle. Now, what I'm talking about is figuring out which stocks do well throughout specific time periods. Let me present you with a classic graph that will assist you in doing so. As you can see, transportation systems and capital goods stocks do well during the early to middle phases of the market cycle. How so? Because things are beginning to develop and the economy is heating up. Transportation is becoming more important. Investing in Netflix, Tesla, and Amazon 10 years ago, just as the market was beginning to heat up, was a great idea. However, as the cycle progresses, the more conservative stocks began to do better. Consumer non-cyclicals and healthcare are two examples. So, what's the deal? Humans still need to eat, use toothpaste, shampoo, drinkable water, and so on. Thus, consumer and non-cyclical stocks are safer to purchase during a market slump. People also require medical attention. Therefore, healthcare stocks in the later phases are also beneficial. And this is what I'm referring about. As a newcomer to the stock market, you should be familiarizing yourself with these concepts. You must understand which stocks perform well and when. You may purchase the strongest stock in the world, but if it is in a poor sector, you can lose. As the adage goes, one of the reasons I enjoy following Ray Dalio is because of this. He provides historical information and connects it to the current events to help us understand where we are in the market cycle. After that, I'll be able to properly prepare my portfolio for the market circumstances in 2022. Therefore, if you're a new investor, I'm sure you would love if you had begun 10 years ago when the economy and market were at their infinite. But at the end of the day, all you can dwell on is the present market circumstances. These simple pointers that I've given you will assist you navigate the waters of these unusual market situations in 2022 and beyond. I wish you all the best of success and hope you are able to achieve those great investment returns. And with that, our video for today comes to a close. To express your love and support for this video, click the like button below if you haven't already. Also, don't forget to subscribe to the channel by clicking the subscribe button and hitting the notification bell next to it to be informed when we have a new video. Thank you for taking the time to watch. We hope you enjoyed it, and we look forward to seeing you in a future episode.